Your bank could lock you out of your money with zero warning. 66. American banks are already on the FDIC's danger list right now. In 1933, Roosevelt closed every bank in America overnight. 8 days, no access. 4,000 banks never reopened. Today, I'm revealing the 3-step protocol used by the 1% to stay liquid while everyone else is locked out. Here is the trap most people are sitting in right now. Your paycheck lands in a checking account. Your retirement sits in a 401k. Your emergency fund is in a savings account earning almost nothing. You feel secure because the number on the screen hasn't changed. But that number is not your money. It is a promise. And promises break. Right now, 66 banks in the United States are officially on the FDIC's problem bank list, institutions holding over $84 billion in combined assets. That list only shows you the ones regulators have already flagged. It does not show you the ones that haven't been caught yet. Here's what makes this moment different from a normal slowdown. Commercial real estate debt is collapsing. Over $1.2 trillion in commercial property loans are in distress or default right now. Regional banks are the ones holding the majority of that exposure. These are not Wall Street giants with unlimited Fed backstops. These are the mid-size institutions where millions of everyday Americans park their money, run their small businesses, and keep their savings. When a regional bank hits its stress threshold, the freeze does not come with a 2-week notice. It comes on a Friday afternoon. By Monday morning, your debit card stops working. Your wire transfer gets held. Your direct deposit bounces back to your employer. The FDIC steps in, and you wait. Days, sometimes weeks. Your 401k is not safer. If the institution custodying your retirement account enters a liquidity crisis, your access gets suspended during the resolution process. The money may eventually return, but you cannot touch it when you need it most. That is the illusion, stability on the screen, vulnerability underneath. Now watch what the people who understand this system are actually doing. Central banks globally purchased over 1,000 tons of gold in both 2023 and 2024. That is not a coincidence. Poland, China, India, and Turkey are all aggressively moving national reserves away from dollar-denominated instruments and into hard assets. They are not doing this because the system is healthy. They are doing this because they know what happens when it isn't. Billionaire family offices have quietly rotated a significant portion of liquid holdings out of traditional banking instruments and into short-duration treasury bills held directly through TreasuryDirect, bypassing commercial banks entirely. They are also accelerating allocations into private credit, physical commodities, and foreign real estate denominated in non-dollar currencies. BlackRock, the largest asset manager on Earth, published guidance in late 2024 explicitly recommending reduced exposure to long-duration bonds and increased allocation to real assets and inflation-resistant instruments. They are telling their institutional clients to get out of the exact positions most retail investors are still sitting in. The pattern is clear. The people who see the system from the inside are quietly moving their wealth to places a bank freeze cannot touch. You can do the same thing, and you do not need to be a billionaire to do it. Here are 4 specific moves to make right now. 1. Open a TreasuryDirect account today. You need to bypass the middleman. By using TreasuryDirect, you are no longer a creditor to a failing regional bank. You are a creditor to the US government itself. It's the difference between standing on a sinking ship or the dock. This removes your cash from the commercial banking system entirely. You are lending directly to the federal government. In a bank-free scenario, your treasury holdings are completely unaffected. Start with your emergency fund. Move 3 to 6 months of expenses into short-duration T-bills, 4-week or 13-week instruments. They are liquid, they are yielding above 4% annually right now, and no regional bank failure touches them. 2. Allocate 10 to 15% of liquid wealth into physical gold or silver. Not an ETF, not a gold mining stock. Physical metal you can hold. Store it outside the banking system, in a private vault or a home safe. This is the exact move central banks are making at scale. When currencies come under pressure or accounts get frozen, physical metal is universally liquid. It has been for 5,000 years. The 1933 bank holiday wiped out depositors. People who held physical gold survived it. 3. Spread deposits across multiple institution types. If you must keep cash in the banking system, split it strategically. Keep no more than $250,000 in any single institution that is your FDIC insurance cap. But more importantly, diversify the type of institution. A credit union, a large national bank, and a direct treasury account creates 3 separate layers of protection. When one locks, the others stay accessible. Build a 30-day cash reserve outside the banking system. Physical cash in your possession. This sounds uncomfortable to most people, and that discomfort is exactly why they are unprepared. In 2013, Cyprus froze all bank accounts over a weekend. Citizens could not withdraw cash for days. ATMs ran dry within hours. The people with physical cash on hand kept buying food, fuel, and essentials, while everyone else waited in line for nothing. 30 days of living expenses in cash is not paranoia. It is infrastructure. Here is what makes 2026 the specific window you cannot ignore. The Federal Reserve is walking a razor's edge. Inflation has not been fully defeated. Rates remain elevated, and every month that rates stay high, the unrealized losses on bank balance sheets compound. Silicon Valley Bank collapsed in March 2023, precisely because rising rates destroyed the value of its bond holdings. That mechanism has not gone away. It is still sitting inside dozens of institutions right now. The commercial real estate wave hits its peak refinancing cliff in 2026, billions in loans written at low rates during 2020 and 2021 are coming due for renewal at current rates that are 2 to 3 times higher. Developers cannot refinance profitably. Banks holding those loans absorb the loss. The ones with thin capital buffers do not survive it quietly. Add to that the accelerating global de-dollarization push, the unresolved U.S. debt ceiling pressure, and a presidential election cycle that historically produces policy uncertainty. And you have a convergence of triggers that does not exist in normal years. This is not a prediction that the entire system collapses. It is a clear-eyed recognition that the specific vulnerabilities in place right now make a regional bank freeze event, affecting millions of everyday account holders, more likely in the next 12 months than at any point since 2008. The window to move is before the event, not during it, not after. Take one action today, just one. Open the TreasuryDirect account. Buy 1 ounce of silver. Move your emergency fund. Do not wait for a headline to tell you it is time. By the time the headline runs, the doors are already closed. If this channel gave you information your bank, your financial advisor, and your government will never volunteer, hit subscribe, because the system will not warn you when it is about to fail. This channel will